Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott weight outlook, and the long-short report covering all asset classes.
Hi everyone, and welcome to another episode of The Truth About the Markets, because I see charts and charts don't lie. That's what we've been doing here at Indiacharts, publishing month after month, week after week, and trying to get the right view, right opinion across. Sometimes in the short term, we do get gyrated, as all of us do at times, but it's really the big picture that keeps us on course and has held on for the longest period of time. And that's the only mental backdrop to be prepared for. So even if I go back to Feb of 2025, I wrote a report which said, don't blink, no matter what happens. And then it happened. You got Trump with all his tariffs announcing everything up to 200 and 300% on China before backing down on the entire theme. It was a very important event in history because we often end up believing that everything that is happening today has happened before and will play out in exactly the same way. What we often overlook is that the people in charge, those in power, may be smart people, and they might have also studied history as much as we have. Which means that even if you go back to the GFC, the Great Financial Crisis as we call it now, the housing bubble, and after 2009, when the Fed really stepped in, a lot of the perma, bear and gold bug community lashed out on the impact that quantitative easing would have. Many of them were very clear that this is not sustainable and you're going to get a hyperinflation, or you're going to get a collapse, and there's going to be a debt jubilee, etc., etc. Now, these things play out in many different ways, and over the years, I've heard many different angles to the jubilee, and it can actually, if you look back in history, many times, in fact, most times, debt is inflated away. There are very few times that you actually had a default. And the other part is that all the predictions as to how QE would end in hyperinflation have already gone wrong, because QE started more than 15 years ago. And if you spent 15 years trying to say this is what is going to happen and it did not, in fact, the exact opposite did, then we already have it wrong. Now, we can again further justify that by saying, oh, but on an inflation adjusted basis, blah, blah, blah. But the fact is that if there are growth stocks in the market and you own them, then you couldn't beat them. They really beated inflation. So you couldn't really beat them with inflation. So I'm of course not just referring to not just the Mag 7 and Mag 5 that people talk about today, but you had the FANGs also, right? So you have had these 5, 10, 8 stocks over time, over the last 2 decades, that have done excessively well. And even if you come to a country like India, there have been entire sectors that have done exceedingly well, whether it was the NBFCs in the 2010s when all that was happening globally. Of course, FMCG did well, but I'm talking about new emerging sectors, as FMCG was a sector that really had died in the 1990s, bear market cycle or business cycle, as we might call it, or the economic slowdown. And it has re-emerged in India in its new form with all the new guidelines from RBI and freedom to expand and become much, much bigger during that time period. And similarly, you had many multi-baggers in mid and small caps over the last 5 years. Now, if you really participated in that part of the story, did you beat inflation? And I put out a chart of Sensex divided by CPI. So even if you may say S&P couldn't beat inflation, some people may claim the Nifty and Sensex since COVID, since 2020, has definitely been beating inflation on a CPI adjusted basis. So we have moved away from the regime where, you couldn't beat inflation on a CPI adjusted basis on the indices for 10 years. But now you are doing that, and therefore equity is the better odds of getting us through this, even if there is an inflationary event. So that's something very, very important to understand. But in a sense, if the actions taken over the last decade, whether it was you call it money printing, or you call it expansionary policy, or simply the buying of bonds to safeguard interests, etc., it worked out. In fact, they managed it very, very well despite all the criticism. If you look back at it, even though right now all the criticism against Powell being behind the curve, which is sort of happened, right? Because when inflation rates shot up to 6 and 7 and 8%, he was saying it's transitory and was not raising rates soon enough. And now when inflation rates fallen back to 2%, he's acting like it's transitory and not cutting rates. Even though tariffs are supposed to have only a knee-jerk reaction on a year-on-year basis, because it's a one-time effect, right? You will have, and you'll see that bump up and then it will flatten out. So truly, this is the real transitory inflation due to tariffs that really comes. But the main point coming to is you'll end up comparing the Trump tariffs with smooth Hawley tariffs that caused the Great Depression or happened during the Great Depression and worsened it. And so this must be the bad thing that was really to happen, history repeating itself. But again, that's based on the belief that we may not have studied history. So even the Fed studied history of money before they went on this QE program, and they had it all worked out in terms of how they would manage the situation, and it has been managed. Similarly, on the tariff front, if we thought that 70-80% tariffs are going to stay and cause the Great Depression, the answer is already in front of us. They are not. Dates are being pushed forward and moving towards what I called in Feb of 2025 is the new free trade agreement. Essentially what the US is doing, on the one hand, of course, they're putting tariffs on countries where the cost of production is very, very low. And by doing that, they increase their revenues and reduce their debt. So this is part of the debt reduction program on the one side, without really doing away with, demand, because the US is still consuming, right? It's still growing. And that means that even with that 10 or 20% tariff that will put on various countries from where they import most, they will still continue to consume from those countries, right, at the tariff and collect that tariff. That is one angle to it. The second one is that creating free trade, which means they'll not only provide entry to other countries into their markets, which most countries already have, maybe they'll open up in certain areas with the desire that they also get entry into those markets in areas that they did not. And that's part of what we've just seen it overnight on Indonesia. They now have a 19% tariff on Indonesia and complete entry into Indonesia, as the trade deal says. And in fact, the Indonesian stock market probably preempted that with a rally over the last 10 days. So they were already anticipating something. So that brings us to India. India has been in talks for quite some time. We keep hearing that there will be a deal or a mini deal or something. And while the US president was announcing the Indonesian deal, he said we are on something on similar lines with India. Now, of course, there's the base 10% tariff. All we need to see is how far up does he move it on the curve. And a lot of that will depend on how far we allow them into India in terms of products and services. Now, whatever the newspapers are saying, they say it's stuck around the GM issue, right? The genetically modified seeds, etc., and modified foods. And that might be the only contentious issue. And once we get around it, I think you will have a deal announcement. I'm just hoping that it's sooner than later, so that the markets can quickly start discounting it. Because while markets do anticipate these things in advance, so far our market seems to be dulled down by the earnings season. And therefore, that's the only positive that it can wait for. But you really want to hear it out, because, we've heard so many things go back and forth from the US side that we often get scared by the comments. And therefore, people would actually want to hear the news or see the actual paperwork on what has been signed off in terms of a deal. So, but we are getting closer and closer to that moment. So it could be any day now, any week now, that you'll finally see the white paper. If it's already been done for Indonesia, the Indians cannot be far behind. And whatever it may look like, apart from a few restrictions in some zones of concern for India, I think you're essentially going to see this turning out to be a movement towards free trade. And free trade essentially meaning that asking countries that had barriers to pull them down, as US is anyway kept its barriers down. And if there are any pending barriers with any country, they might also get pulled down. So essentially, you will be looking at both countries trading with each other better than before, and that is essentially what I call as a movement towards more free trade. So again, to repeat what I said in my video in Feb, is that this is not deglobalization, this is reglobalization. So often people didn't understand that, or don't get it, or didn't believe it, but now months later, after tariffs have been put and are being rolled back, and active negotiations going on, and a comment by Besant overnight that the US Treasury Secretary that they are in talks with China, and so the 12th August deadline is not a deadline to keep an eye on. And this is essentially how it's going, right? Because the main object is to have a conversation. And the same they've said for Europe. They've put sent a 30% letter, and then he's like, it's there, but yeah, we're having talks. So everything is about having talks and moving towards more free trade with everybody and pulling down barriers. So in the end, when it's all done and dusted, what is the world going to look like? That is more important. If you have that vision in mind, then you'll see it very, very differently, rather than the negative narratives that you'll continue to hear in the quote unquote media, because whenever I use that word and because I do appear in media, they end up calling me and asking me, what the heck are you saying, what did we do? And it's not that. It's just that a lot of things are talked about in a very, very different way. We aren't looking at the end goal, and the end goal or the end picture, if you actually see all this in a post-negotiated world, what you're going to see is free trade with some changes in pricing, right? Pricing for everybody who sells to the US just goes up a little bit, whereas US gets entry, and they also get entry into areas of US that they didn't have before, if at all. And that means we have free trade between countries more than before. And what can be the end result of that? You all know the answer. It essentially means more growth. So actually, this is a push towards globalization, which results in higher growth, not lower growth, unlike what happened with the smooth Holly tariffs in the midst of the Great Depression. So very, very different outcome that you can have if the idea behind it is very different. It may be made to sound like the worst thing on earth because that's nice. The perma bears hear it, everybody goes short, and then we can tell them that, see, this is not what it was free trade. You got it all wrong, and you get short squeezed out into the moon. And that is essentially what has happened to the US markets, because they are close to all-time highs, and Europe, they are close to all-time highs, and Indonesia, which has sort of recovered from there, and Israel, which rallied through the war. The only place which is not back up there is India. Of course, we've recovered from the April lows, but we seem to be struggling, and we are struggling partly because our earnings season is not expected to be good. So we really need something else to keep driving this. The technical setup is, of course, that we have a bottom in April. Sorry, we are not going back to 21,000 for those who are still waiting for it. I'm still getting people telling me this is a bear market rally, it might crash, deeper correction. But I somehow feel that none of that is going to happen, because sentiment indicators, as we talk about them over and over again and are published on Strike Analytics, scrollable charts that you can look back in history and actually check what has gone on and happened, allows you to really know where we are today in a historical context, and where we are is close to the highest short positions of the last 2 years. Of course, not higher than where we were in the first week of March. That was the highest all-time record, but highs that we have seen at all previous bottoms before and after that. And therefore, when we are there at almost 1,12,000 contracts short by FIs, it essentially shows sentiment. It's not about the quantity, it's not about whether it's an arbitrage or a hedge. It's about what it reflects of sentiment. When you're willing to hedge that much, as similar as you did before at a previous bottom, then possibly your sentiment is as bad as it could be. That is the way I think about these things, about these data points. And what you're essentially looking for is, when does that turn? It's not turned yet. And despite this rally, every time the market corrects, these shorts get added back. That has to change, and that will change with some positive mindset, and you'll see a short squeeze. So I think we're on the cusp of that. And the news flow will definitely help. And once we discount this earnings season, that will also help. And my sense is that we are continuing to make higher bottoms. If you look at the weekly chart all the way down from the April low to the low that we made on the India-Pak war, then we made a low on the Israel war, and so on. Each bottom has been higher than the previous one. And right now also, I think we'll make a higher bottom, maybe closer to or above 25,000. Probably we already have. So, but 25,000 in general, I'm saying might just hold out as the strong support area. We should again propel to another move to the upside. But this is a beginning. This is a beginning of a much longer move, because I think the medium-term correction from September to March, that is already behind us and has happened. Now what we are looking at is the start of a continuation of the bull run. We've already started from April, but continuation into a much stronger phase that lasts for several months or more than a year is what I would anticipate. To read it in totality, you should probably read the latest long short report in context with the previous one or two, because there's a lot that joins the dots. I've covered a lot of the sector indices in the previous one, not in this one, but they all highlight various reasons and various moving factors that are changing that allow us to be on this side of the view. So that's one thing that you should probably try and read out. Now, if you have not really used the data on Strike Analytics, sentiment indicators, etc., there's a lot more. I mean, we only talk about these because they're unique to us. Some of them are proprietary indicators not available anywhere, like the swing for short term, and we're actually about to release one for medium, long term and multi indices as requested by many. Initially it was purely on the Nifty or total market, but as it gets wider, it will serve a bigger understanding of markets across time frames and across sectors. So that will also be out. So yeah, if you have not really tried it, you can get a trial longer than the one you get online. So if go online, you only get it for 7 days. But if you have never used Strike before and you want to try it out for the next 30 days, you heard it on this podcast. So you essentially have to DM me for that on 9167650642. That's the number. So if you DM me on that, I will give you an extended trial period. So essentially it's for serious users. Serious users would be people who listen to a serious podcast like this, and therefore I'm putting it out here and nowhere else on the web. And if you're interested in the next batch of the mentorship program, so we've started to do more batches and we're trying to do that. We used to do only one a year. We'll have another one starting out between September and October. That interests you, then you should probably call Soumya. She'll take you through it, make you a lot of promises that she will keep. So she's not just telling you things, but she's good at doing that. And the number you need to call for that is 99038 77397. So these are two numbers I'm leaving you with for those interested in the mentorship program and deals there, and those who want to try out Strike for the first time ever can DM me. If you have already used it and have an account, then of course I can't do anything, but for those who have not, this is a shout out. If you have only used the trial and never subscribed and you still want to give it that final tryout, okay, fine, I'll allow those as well. But of course, you remember, we can check that at the back end. So only if you've used the trial and not subscribed before, we can give you a shot at it. So that's the offer that I'm making. With that, stay tuned to the markets. We are at the end of almost getting to the mid of July. The next 2 weeks will be interesting as everybody eyes the 01 August deadlines, but it's already become apparent with the comments this week that these deadlines are not important. What's important is that we get the deals through, and they are working day and night to make it happen. So when somebody works day and night to make it happen, I can tell you this much, it's going to happen. We are going to be in a deglobalized free trade environment for the world 6 months from now. Okay, and the markets will smell it out and start discounting it much faster. Now for India, one more thing that will work out will be the interest rate cycle. The US may be way behind the curve on the interest rate cycle, which I spoke about in the beginning. But India is already ahead. It's joined Europe, but we were behind. I mean, if you ask me, last year we were just like the US. We had a governor that was unwilling to move for months and months, no matter whether inflation came down. He didn't want to cut rates. I think that's where you're becoming insensitive to market situations. Sure, inflation can come back. It can always come back. It can come back 1 year from now. But if it's down today, shouldn't you adjust rates to the market conditions existing today? So if you're not a dynamic governor and central banker in today's world where things are changing every day, every week, every month, then you're sort of setting up yourself for disaster. I think that is the thing to take away, just like the over intervention of currency markets that I've spoken about before. But all that seems behind us. The new governor has come with a completely different stance. He stepped back from over intervention in currency markets. You can already see that with the increased volatility in currency markets. And I don't call it volatility, I call it trendness of the market. There should be a trend. If it wants to weaken, it should weaken. If it wants to strengthen, it should strengthen. There should be any big force trying to stop that from happening. In fact, banks and forex desks actually make money out of these trades when there is some amount of movement, and that should be permitted. And the other part is that they've actually moved on to the interest rate cycle pretty aggressively, cutting up to 100 basis points in this time period, with the recent 50 basis points front loading, which I'm really happy about. And I'd hoped for that months ago, but it happened with the coming in of the new governor. Now of course he's moved back to a neutral stance, which is part of him being careful, I think, because naturally we've had a history in India of higher inflation rates, and therefore that fear remains. But I think clearly his bias was to move towards data dependency. That is what he said in the press meet, and the data continues to show weakening inflation data. And I think he's given an interview to CNBC yesterday saying that if this pattern continues, there would be a room for rate cuts, something that I have been saying for quite a while. There are going to be more rate cuts. The bond market chart is what tells me that, not an economic analysis. I look at the India 10-year bond yield, and I've been doing that for a long period of time, calling for this next wave C down, which is a major reduction in interest rates in India that will happen over a period of time. That cycle didn't play out immediately after COVID, or in fact in 2018 also, because we had the ILFS crisis and all, and after that rates did start to fall, but then they bounced back in 22 due to the inflation spike globally. But finally, I hope we are in the midst of that, because all those declines also have led to lower highs in the long-term chart in the bond market. So they are indicating that the larger trend for bond yields in India is down. But we need to get into what we call the third wave, right? The third wave where everything accelerates and you get big interest rate cuts. And I think we are now into that phase. Though the RBI may be holding back a little bit, I think the case will develop given the slowdown that we are still seeing. Because what happens is you do 2 rate cuts, it doesn't work, then you're forced to do one more. And that is where, and if you have support from inflation, it allows you to do that one more till you get things kick-started. And I think that is where we are right now in the Indian economic cycle, that we are beginning to use monetary policy to kick-start the slowdown that we've seen in economic activity. And it is picking up at a slow pace, but they'll continue to, perk it up till they get the momentum that they need. So that is my view on the overall picture of what is happening. Markets, like I said, should not go below 25,000. We should be headed far higher from here. But all this negativity creates an apt environment for investing, because a lot of stocks which have not yet moved and that are still showing earnings growth, especially in the second line or even the large cap. So there is earnings growth. It's not that there's no growth. It's just that you have to find the right stocks where the growth rates are higher and continue to stick with them. And those stocks are actually outperforming the market even in the last 1 month. So that is what you should be focusing on. It's a great opportunity to buy these dips that you're getting again and again and again on the investment side. For trading, it is making it difficult because when you get a zigzagging market, 500 points up, 500 points down, the cutoff points become pretty hard. Unless you started out with a view that it's going to be a trading market. If you expect a trending market, like I do many times, then it does hit back every time it falls more than we think. But that does not change our view on the big picture. So that's all from me on the truth about the markets. Rohit Srivastava signing off. Until next time. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.